On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. I wanted to talk today about a soft landing and the prospect that the Federal Reserve, the US central bank, might have done not quite the impossible, but at least the very rare and achieved one. A soft landing is always the goal when a central bank raises interest rates like they have in the last couple of years to knock inflation on the head. And while there's no official definition, it generally means getting price increases under control, reducing inflation without causing a recession or a major economic slowdown in the process. And to do that, policymakers, whether it's the Federal Reserve or the Reserve Bank here in New Zealand, they need to ensure that even though they slow the economy down, unemployment doesn't rise too much, despite the fact that they're actually making an effort to try and slow activity and constrain activity. And it's a very difficult needle to thread. The central banks around the world only have a mixed track record of achieving this because most of the time, when interest rates rise sharply, you do get an economic slowdown, you often get a recession, and you often see a spike in unemployment. In the United States, there have been a few exceptions. We had the hiking cycles of 1984 and 1995. Those were the peaks of those respective hiking cycles that started a year or two earlier than that. Those two times, we didn't see a recession follow, even when interest rates had reached a high level from a lower starting point. However, things were quite different then. Interest rates didn't rise as much during those two periods as they have in the last 2 years. In the last 2 years, they've risen from near zero to much higher. In the case of the US, they've risen from near zero to 5.5%, which is the highest we've seen since 2001. So back in those two examples, we didn't see such a rapid increase, and inflation wasn't nearly as high to begin with. At its peak this cycle, we saw inflation by some measures pushing above 9% per annum, which is the highest we've seen since the early 1980s. Now, Federal Reserve Chair Jerome Powell has also suggested that the Federal Reserve was on course for another soft landing in 2020. That was, of course, before COVID-19 threw a spanner in the works. So we'll never know. But that might be true. It is a fact that the Fed had already started cutting interest rates in the middle of 2019, and they may well have started doing that early enough to avert a naturally occurring recession had the pandemic not hit in early 2020. So we won't know. But look, if we give them the benefit of the doubt and include that example, that's 3 times in the past 50 years where you could say the Fed has achieved a soft landing. The hiking cycles that ended in 1984 and again in 1995, and then the one that ended in 2019 but was curtailed by the pandemic, which threw everything into disarray. Now, that's 3 times, but in contrast, I can count 6 examples of the Federal Reserve hiking interest rates in the hope of taming inflation, but recessions following soon after. So history is definitely against it. Although when you look at several recent indicators, including a couple of data points that we got just last week, it does suggest that a successful touchdown might be looming. We haven't achieved that soft landing yet, but to steal a phrase that I heard Claudia Sam, the ex-Fed economist, use, maybe the runway is within sight. So we could be close. It's really interesting what we're seeing at the moment. The Fed's preferred inflation measure, which is the Personal Consumption Expenditures Price Index, the PCE index, that's now fallen back below 3%. So it starts with a 2, having been much higher And if we annualize the average of the past 6 months of those readings to gauge a more recent trend, then it's sitting at 2% or slightly below that at both the headline level and the core level. Headline level 2% bang on, and core PCE inflation is 1.9% using that sort of measure. So that's right on the Fed's target. Their target is 2%, and on that basis, we're there. At the same time, the US economy has held up very well, hasn't it? We saw some economic growth data last week. This was for the December quarter. It came in above forecast. It was at an annual rate of 3.3%. That's higher than what markets were expecting. And at the same time, you've had the unemployment rate that has been below 4% for 2 years, 24 consecutive months. Now, that resilience has surprised a whole lot of people and a lot of economists who have been calling for a recession or a major slowdown for a long time have been so far proven wrong. Maybe they'll be proven right in the future, but so far we just haven't seen that. And I guess there was always going to be a chance that the usual indicators, the usual signposts, the usual things that economists watch to give them that early heads up about recessionary conditions, there was always a chance that they wouldn't prove quite as reliable this time around. And I think that's just because of the uniqueness of the last few years. You know, maybe some of those pandemic induced supply side challenges were always a bigger factor than rampant demand. So, you know, maybe inflation was somewhat transitory, with it being largely a supply side issue because of the pandemic situation. Then you throw in the Ukraine war and some of the other things that we've seen in recent times, and maybe that was more relevant than the strong demand as a result of lower interest rates. Who knows? There will be people out there that will caution all of us about the potential second wave, potential resurgence in inflation, and that's fair. We should keep one eye on the future and be thinking about those sorts of risks. But so far, a lot of the evidence actually says that the job is done. We have seen inflation fall back to pretty much the Fed target. So they're there. And we haven't seen the economy fall over, and we haven't seen a big spike in unemployment. Unemployment still starts with a 3, which is very low by historic standards. So if all of that's the case, then is there any need for these high interest rates to overstay their welcome and cause an unnecessary recession in the United States? I wouldn't think there are. Many indicators are giving the Federal Reserve the green light to start easing policy settings soon and to start reducing interest rates. And I think the Fed will be wise to listen. For investors, this would make for a much more attractive backdrop. It would mean that markets could well perform better than many expect, and that the long awaited collapse in prices some people have been calling for, it might not come. And if that's the case, I think those of us that have been waiting patiently for that lucrative buying opportunity to emerge for when everything comes crashing down and we get some great buying opportunities, we might find ourselves left behind because that might not happen. So from where I sit, I look at some of this data. I don't think we're completely out of the woods. You never are. There's always something that might come from around the corner. But there are some genuine signs that the likelihood of a soft landing is higher than we thought it would be at this point. And I think if the Federal Reserve does take some action soon, which I think it should do, then there is a chance that they've done the unlikely and pulled this off. And if that's the case, I think it might be time for us to take some action now rather than waiting for that opportunity, which might not ever come or might not come in the same sort of degree that we have been all hoping for, or that many of us have been hoping for. So we'll leave it there. If any of that is interesting, please talk to your advisor. I think another point that is worth noting is that when we do talk about markets, they've had a very strong run, particularly when we think about the all-time highs that we're seeing in places. Let's just remember that those are isolated. It's the S&P 500 in the US that gets a lot of attention. That hit an all-time high earlier this month, but there are other markets around the world that haven't rallied to anywhere near that same degree, and many of those other markets are trading at levels that are much more modest. And even when you look at the US, I think if you would isolate different parts of the markets and different sectors, so if you look at large caps versus small caps or defensive cyclicals, large, small, whatever you want to call it, if you segment the market out, what you will find is that there are plenty of areas that haven't performed as well as others, and that a lot of that heat that has taken the index to an all-time high has been quite concentrated. So it's a little bit of a myth that everything's expensive, and if you haven't got moving and started investing, then you have missed the boat, because you haven't. I think it's just a case of having to work a little bit harder and look a little bit more carefully for opportunities. So that would be my advice. Get some good advice and consider making some changes.